The broadcast is now starting. All attendees are in listen-only mode.
Thank you all so much for joining us here on CPA Academy. This is Jason Bookman. I will be your moderator on today's webinar on blockchain, Bitcoin, and cryptocurrency, taxation, and regulation. We have Jason Freeman, who's going to be presenting for all of you over the next hour. And before we get into today's session, I want to go through some technical checks and housekeeping, make sure that everything is working for everyone. So if you haven't done so already, let's go over to the GoToWebinar questions panel, part of the control panel dot in the corner of your screen. Inside that questions panel, please let me know that you can hear me. Let me know that you can see the slides. Feel free to let me know where you're listening in from, what brought you to today's webinar. So far, I see a lot of comments coming in. Good for us to know that everything's working through GoToWebinar. Of course, I just want to do a quick bit of technical housekeeping regarding GoToWebinar itself. If anybody is having any problems with sound or visuals, go ahead and let me know in this questions panel. I'll do the best I can to get the troubleshooting done quickly and put your focus where it needs to be. And of course, the one big asterisk, the one big disclaimer, as you all know, with so many people sheltered in place, working from home, systems like GoToWebinar have a lot of extra users. And if we do encounter any technical difficulties, any large systemic problems, rest assured that we here at CPA Academy are doing everything we can to make sure that everything is working as quickly as we're able to get it working. Should we encounter any big technical problems, we ask for your patience, we ask for your understanding as we get everything off the ground again. Now for some quick housekeeping regarding credit for today's session. This is a 1-hour webinar. Qualifies for 1 CPE credit for CPAs and 1 CE credit for IRS enrolled agents. The way you earn that credit is fairly straightforward. Just stay logged in for at least 50 minutes out of the 60 minutes of our allotted time and answer the poll questions. Polls pop up on your screen periodically throughout the webinar. When that happens, all you need to do is hit the button best corresponding with your answer and then the submit button on the GoToWebinar poll box. We here at CPA Academy are going to use those polls and your time logged in to issue credit, which will be done by the end of the day today and available in your CPA Academy account within 24 to 48 hours. That will, of course, be accompanied by a copy of the webinar handouts, which are available right now in the handouts section of the GoToWebinar control panel, as well as an archived copy of today's webinar. If you are an IRS enrolled agent, if you're a PTIN holder, please make sure your name and PTIN are input correctly in your CPA Academy account. We will issue IRS credit at a later date, so that will not be available within 24 hours, but rest assured, it is on its way. And now that I've gotten through all of the technical housekeeping, I know everyone can see and hear, I'm going to step out of the way and turn today's session over to our presenter. Let's give a warm welcome to Jason Freeman. Jason, the floor is yours.
Jason, thank you so much, and glad to be here with everybody today as we dive into this topic, blockchain, Bitcoin, and cryptocurrency, taxation, and regulation. I know everybody's joining us in this unprecedented and crazy time, and we've been doing a number of presentations on the platform here in the last few days, dealing particularly with coronavirus related relief. I will go ahead and plug those and let you know that if you for those of you who are out there wondering about that topic, we've got some information on the page for that, where you can download an outline specifically dealing with that. That'll hopefully get you some information as you try and make your way through. But I'm kind of looking forward to today to shifting gears and talking about a topic that I have a lot of interest and really enjoy working in, dealing with blockchain and cryptocurrencies. For those of you out there, really, unless you've been living under a rock for the last 5 to 10 years, you're familiar, you have at least some degree of familiarity with cryptocurrencies and blockchains, even if you've only, just heard of them. Many of you have clients actually using virtual currency. And, as you know, when you stop and think about it, the use of virtual currency raises some very interesting tax, regulatory, even philosophical questions. Should they be regulated? Who should regulate them? Where do these transactions take place? And, fundamentally, what exactly is it? Because as we're going to see as we dive in today, there are varying viewpoints about what exactly it is from various federal regulators, and so we're gonna see that not everybody agrees, but many agencies have gotten in on the mix. And then, again, one of the fundamental questions that I find just fascinating is, jurisdictionally speaking, where do these transactions take place, and who should actually regulate them? As we'll see, when it comes to looking at a blockchain based transaction, there's an argument to be made that it occurs everywhere or nowhere at the same time, and as you can imagine, that presents some uh, very interesting questions, jurisdictionally speaking. Um, so let's see if I can get these slides to advance. A little bit of difficulty early on. Um, so as we dive in, one of the questions here is, why should you care about this? Well, obviously there's a lot of people on the line who have clients dealing with this. For those who don't, just a short bit of historical context here to understand why this is definitely something that you need to know about. The IRS and the Department of Justice back several years ago, really dating back almost 3 years ago at this point, um, they issued something known as a John Doe summons. Sorry for the slides. I'm having a little bit of delay on the switch here.
Is everything okay now? You should just be able to use the arrow keys to go back and forth.
Yeah, I am. There's just about a 5-10 second delay on it. More there. So, about 3 years ago, the IRS, Department of Justice, issued something known as a John Doe summons to Coinbase. Coinbase being the largest domestic virtual currency exchange in the United States. And the government was seeking information related to account holders at Coinbase, specifically for the virtual currency transactions that they had from the period 2013 through 2015. And the for those who aren't familiar with the John Doe summons, or what exactly it is or does, this is basically a summons that's issued generally to a financial institution that says, hey, we don't know specifically the name or identifying information of the individual that we're looking for, but here is a category of people that we believe exists, and we want the information on all of those people. And so this John Doe summons was, expected to extend really to several million taxpayers. Well, as part of that, as part of the judicial fight that ensued after the issuance of this summons, the IRS filed several affidavits from officers into the case, and one of those that caught my eye indicated that after reviewing IRS records, they had come to the conclusion that there were, during this period, this 3-year period, some 800 to 900 taxpayers who had who had reported their virtual currency transactions, as the IRS believed should be the case. And the IRS indicated, look, the number that would be expected is several million. Now, I'll start out by saying I take issue with those numbers. I just anecdotally doubt that they are correct. But one thing that I I think is absolutely correct, and is the bigger point here is the IRS believes there's an enormous amount of underreporting and non-compliance when it comes to virtual currency. Indeed, they've really indicated that they believe this virtual currency is the new and improved Swiss bank account. And just to tie another parallel together, for those who are familiar with the international, kind of the revolution we've seen in international tax over the last 10 years. And my firm has done, a lot of work with international tax issues. Well, that all started, if you look back, that all started back in '08 and '09 with the issuance of several John Doe summonses to a number of Swiss banks. And what the IRS ended up doing is leveraging the information they got back from that, starting the so-called voluntary disclosure program, and then a sister adjunct program to that, and ended up having about 100,000 taxpayers come forward and disclose previously undisclosed foreign accounts. Well, anyways, the point being that's relevant for us is the IRS is taking a play straight out of the playbook from the international tax realm and all of the success it had there, and is applying that play to the cryptocurrency realm. The point being here for you is the IRS is devoting a lot of resources and believes that this is a very important area. So let me give you a few very practical pointers that you can take away for your practice. So for those of you who are already dozing off, this is me telling you, hey, I'm going to give you for just a couple minutes some very practical pointers, and then we're going to go into a little bit more detailed slides and try to give you, my goal is to try and give you a high enough level understanding of what's going on with this technology and the innovations to allow you to kind of give you the tools to use the rules and the working framework that many of you are already familiar with and apply it in this context. But in terms of the practical pointers, look, one of these is year-end organizers. You need to use and incorporate questions about virtual currency transactions in your year-end organizers, just like we started doing years ago dealing with offshore accounts. In terms of how these are reported, generally it's a Form 8949, sales and other dispositions of capital assets. That's generally how you're going to report these. Now, that's not a universal rule. In some circumstances, ordinary income treatment will be appropriate, depending on the context. But for the vast majority of instances, that's going to be how they're reported. Accounting methods, confirm the accounting method that's used by a third-party exchange if that's where you're getting data that you're using to report. Keep in mind that throughout the years, we've seen that various third-party exchanges have used kind of their own, various methods of accounting, and so you need to be able to convert that data into something that is usable and recognized by the IRS. Educate your clients on loss limitation rules. The limitation rules for deducting short-term capital losses. Case in point, we're in one of those periods in history right now where assets are particularly volatile and are, have decreased in value compared to where they were a month or two ago, generally. And so, with cryptocurrency being a particularly volatile asset, these limitation rules can come into play more often than otherwise, and make yourself into the good guy, educating your clients about these up front rather than come tax return time. Futures and other options. I just point this out to let you know that there are some other avenues for clients that want to invest in cryptocurrency. And some of these may be to utilize things like futures. Um, and I say that for our audience in particular because this is a mechanism that allows investors to invest in instruments that track cryptocurrency trends. But for our accountants in the audience, this basically gets rid of a lot of the uncertainties that still exist with respect to reporting of these transactions and really simplifies the process. So look, you can't let that tail wag the dog in all instances, but just know those are out there, and in the right circumstances may be an option. Now, there are a host of issues, interesting issues that come up in this context. I throw these out there just to get your brain juices flowing. International reporting, are there FBAR filing obligations or 8938 filing obligations with respect to cryptocurrency holdings? Recall that mentioned as when you really dive in and look at how the technology works, there's a case to be made that the transaction occurs everywhere or nowhere at the same time, and that raises interesting international reporting issues. Does Section 1031 apply? We'll touch on that a little bit towards the end of the program. What about the issuance of equity tokens? Does this give rise to income on the receipt? When there's payment for equity tokens, does it give rise to income? Are there Section 199 Cap A qualified business income consequences? What about other international issues? CFCs and ICO proceeds. What are the consequences here? Some very interesting issues, not all of which we have answers to, but many of which we do. But let's step back just a second and kind of look at crypto trends and understand part of the reason that I mentioned earlier that one of the things we need to do in this area is ensure that we educate our clients about some of the loss limitation rules that can come into play. This is a snippet from of a Bitcoin market price going back to kind of the great run up at the end of 2017 and then the precipitous decline going into 2018. And as many of you know, it's been a very volatile asset really even since then. It's settled in some, but what I was seeing certainly back then was that many of our clients were newly minted millionaires on paper in 2017, and then saw dramatic declines going into 18, and that's just kind of a summarizes some of the client base that you're going to see in this. Jason Bookman, this is probably a good time for us to go ahead and launch the first poll to help make sure everybody credit for today's program.
No problem. I was just about to jump in and make that suggestion myself. So poll question number 1 is now live for everybody. We're going to leave this open long enough to get a majority of responses. So everybody go ahead and get your votes in now. We're going to have 3 more polls following this one, and we're going to close this down in about 45 seconds or so.
So the next slide, we're going to talk a little bit about some of the historical markers, that have, on kind of the past of cryptocurrency and Bitcoin in particular that you need to be aware of. And we talked about Coinbase, which is a very important one. Another was really what was known as. I'm going to make sure we get the slide working here.
Yep. Before we get back to the slides, I'm just going to close the poll in 3, 2, and 1. And Jason, are you able to control the slides again?
I am. There we go. Well, that may not be a good thing. Um,
Looks like it's working. There we go.
Yep. So one of them was Silk Road. Silk Road, was an issue several years ago. Was basically an online marketplace that was created and that was designed to only allow access through something known as the Tor, the Onion router, which was an online viewing mechanism that was designed to really increase anonymity. And transactions could only take place through Bitcoin. So it was again designed to maximize anonymity. And at any rate, this online bazaar really blew up into a black market online website, was ultimately shut down by the feds, and the founder was sentenced to life in prison, and but not before a couple of FBI agents themselves got indicted for stealing some of the founders' Bitcoin holdings, and so it was really one of those incidents that was kind of a black eye for cryptocurrency and something that had to overcome. And then another incident on that road was Mount Gox, which at the time was the largest virtual currency exchange, was domiciled in Japan, and was hacked in an incident that resulted in the loss of massive amounts of virtual currency, or the theft of multiple amounts of virtual currency, and then it subsequently went into bankruptcy. And I use that as really an example of this is an area where if you've got clients in this, it's really incumbent upon you to understand that there are some data security risks. Though in my experience, those have tended to be more associated with exchanges themselves, rather than the underlying technology or infrastructure that cryptocurrency is built upon. So, what is virtual currency? When I'm in person discussing this issue, I always ask a question, for the audience to raise their hand if they've ever seen a Bitcoin, and I inevitably get a number of hands raised, particularly when I have something that's marketing propaganda that, displayed on the slide like there is right now. The truth is, this is not what a Bitcoin looks like. A Bitcoin is really it's a digital currency that's created and held electronically. So, they're not printed like dollars or euros. They are electronic files. So just like a PDF or an MP3 for that matter, they could be lost or destroyed. Indeed, there is a story that is true but apocryphal in some sense, that of an individual who lost a hard drive that held at the time maybe $20 million worth of Bitcoin, that was apparently inadvertently thrown out, and along with it the Bitcoin in value. But again, it's created and held electronically, and really at heart, it is an alphanumeric strand. Really, technically, it is. I would say it's two matching or interlinked alphanumeric strands that are built upon technology that's been around for a while: public key, private key cryptography, and the two alphanumeric strands are linked in a way, as a result of having been run through, extracted through a cipher, and but they are really just matched through complex mathematical principles that basically means one is the private key is like a password, or that unlocks the other. You can think of it like that, or you can almost think of the public key, which anyone can see, and is attached to a blockchain, uh, to a spot on a blockchain. Uh, it's like the private key is basically the password or key that opens account, so to speak, and allows one to access whatever asset is attached to it. Um, so, many are not aware, I guess, that um, Bitcoin, having been the first cryptocurrency, was built upon blockchain infrastructure. So blockchain and Bitcoin came out at the same time, and certainly at that time it was Bitcoin that got much more publicity, and there was much more public knowledge. But I think very soon thereafter, many people came to realize, well, blockchain, may actually present the greater technological innovation, or have greater capacity for revolutionary change in a number of ways. But part of what I want to focus on, so you understand how this is designed to work, is to put the introduction of blockchain and Bitcoin into historical perspective. These were introduced back in the first Bitcoin, known as the Genesis block, was introduced back in January of 2009. And it was introduced by an individual that went by the pseudonym Satoshi Nakamoto. We still to this day don't know who Satoshi Nakamoto is with any degree of confidence, but it was introduced, if you put it in perspective again, it was introduced against the background of the subprime crisis. And, it was designed to provide an electronic source of money or currency that would not require third-party financial intermediaries. Basically, would not require a trusted intermediary to administer or keep the books on the currency, and that's why you sometimes hear it referred to as a trustless form of currency. But that was kind of the whole idea behind the introduction of Bitcoin. And again, it was since that time we've seen, and this is an old snapshot, but it's designed to show you that since the time of the introduction of Bitcoin, we've seen just a host of cryptocurrencies that have been developed. When you really look at what is blockchain, it's an interesting kind of underlying infrastructure. Again, it's really built on these concepts of public key, private key encryption, and a blockchain is really, there's a lot of mysticism that seems to surround this idea and concept, but really at heart, if you want to understand what it is, it's a way that we record data. It's effectively a database. Probably more accurately to say it's a distributed ledger. Generally, these are append only. At least most public blockchains are going to be append only distributed ledgers, where records are basically designed to be immutable and to hold certain information in the form of blocks that are cryptographically attached to one another or linked to one another. So this basically requires that a number of users, generally on a public blockchain, again across the world, will be able to perform a role as a node on a blockchain network, where they can potentially add records to that blockchain, depending upon the particular consensus protocol that is used to administer that particular blockchain. And when I use that word consensus protocol, it basically means the rules of the game. It's how we define what the records on a particular blockchain, what they are. And so, when you see various types of cryptocurrencies, each of them operate for the most part on their own blockchain, and each of them can have, by design, their own consensus protocol. That could be something like a direct vote or a proof of work concept that is designed to embed evidence that the users or those nodes believe and agree with what is provided on the blockchain. It's inevitably it is a bit of a difficult concept, but really at heart, you can think of a blockchain as basically being this distributed ledger or database where information about particular items is recorded in a way that is, again, when it's a public blockchain, designed to be immutable. So if I can get these slides to move, and we have I think we've covered most of these. So, question that I talked about earlier, what exactly is it? There are interesting questions that are raised about cryptocurrency, and where do these transactions, where do they take place, and who should regulate them? So when it comes to what it is legally, we're about to get into the IRS's viewpoint of cryptocurrency and work through the rules that we have there. The IRS has taken the position since it first issued guidance a number of years ago that cryptocurrency or virtual currencies are property for federal tax purposes. Now, not every agency has taken the exact same position. For example, FinCEN, which is a sister bureau of the Department of Treasury, both the IRS and FinCEN fall under Treasury. FinCEN has basically taken the position that virtual currencies are a substitute for currency, and that, of course, brings them under FinCEN's jurisdiction. And FinCEN oversees our Anti-Money Laundering and Bank Secrecy Act regulations and currency reporting. The SEC, on the other hand, Securities Exchange Commission, has found that tokens, particularly ICOs, initial coin offerings, and other equity-like tokens, are actually securities for federal securities law purposes. And that, of course, brings them under the SEC's jurisdiction. The CFTC, Commodities Futures Trading Commission, has taken yet a different approach and has taken the position that virtual currencies are commodities for purposes of its regulatory regime. About the only principle or theme that I've seen throughout this that I can take away is, federal regulators will tend to view this as whatever brings it under their jurisdictional purview. And we haven't even begun to get into how various states or other countries may be treating it. So, the answer is it's a lot of different things legally. Jason Bookman, this is probably a good time for us to go ahead and launch a second poll question.
No problem. Poll question number 2 is now live on everybody's screen. We're going to leave this open long enough to get a majority of responses. I'll close this down when it's appropriate to do so in a little less than a minute. Jason Freeman, back to you.
Thank you. One of the things that you should realize from the discussion I just mentioned is there are varying views that have evolved over time in terms of what cryptocurrency should be treated as for legal purposes. And one of the takeaways there, I think, is this is something you kind of got to stay on top of because it lends itself to changing fairly fundamentally over time. For example, mention the IRS treats it as property for federal tax purposes. It's conceivable to me that there may very well come a time where cryptocurrency takes on takes on more of the characteristics of a true currency, rather than being treated as a property, which may have made more sense when the IRS first came out with its guidance on this. And I don't speak with any inside knowledge about where that's going within the IRS, but just to say that there certainly may be changes in the way that cryptocurrency functions as we have greater and greater adoption of this technology and use of this technology. So let's dive into some of the tax rules, and the way that the IRS treats this. As I mentioned, the IRS treats virtual currency as property for federal tax purposes. So what that means is, effectively, every transaction with cryptocurrency it's effectively a barter transaction. So where one is exchanging property, cryptocurrency, for other services or property, whatever is purchased with that. And what that basically means is that there's a potential gain or loss that needs to be calculated on every transaction involving cryptocurrency. And that means we're going to need to know and keep track of the fair market value of the currency and the basis in the currency, in order to accurately calculate those things for federal tax purposes. And so, that's kind of the main principal takeaway from the IRS treating this as property. How is virtual currency treated for federal tax purposes? We just covered that, but it ties into another question that deals with a common misconception that I get from taxpayers is, is this actually a currency? So for example, could it be treated as a currency for purposes of determining whether a transaction results in foreign currency gain or loss under the tax laws? And look, it's again a consequence of treating it as property. It's not treated as currency. So the answer is no here. Under currently applicable law, virtual currency is not treated as currency that can generate foreign currency gain or loss. Again, a very common question, but raise the somewhat rhetorical question in response here of what's going to happen when the first foreign country or other countries begin to adopt virtual currency as a true legal form of tender, or begin to even just use them short of that, as a normal source of currency. Another common question: does a taxpayer have gain or loss on an exchange of virtual currency for other property? The answer is yes. If the fair market value of property received in exchange for virtual currency exceeds the taxpayer's adjusted basis, the taxpayer has taxable gain. The taxpayer has a loss if the fair market value of the property received is less than the adjusted basis of the virtual currency. So basically, we look to the normal Section 1001 rules that govern the calculation of gain or loss on the exchange of virtual currency. That leads into another common question. What type of gain or loss does a taxpayer have when they sell or exchange virtual currency? And the answer is, look, for for most clients in most situations, you've got, you've probably got a capital gain or loss on the transaction. But the more technically correct answer is that the gain or loss, the character of the gain or loss is going to depend on whether the virtual currency is truly held as a capital asset in the hands of the taxpayer. There are this is a question that you have with any other type of asset, and for example, the code does not treat inventory as a capital asset, and I've come across a number of taxpayers who are effectively holding virtual currency in an inventory like manner, and so you just really got to dig down and understand exactly how the taxpayer is holding it to make a determination on the character of the gain or loss. Jason Bookman, this is another good time for us to go ahead and launch the third poll.
Sounds good. We're going to go ahead and get poll number 3 up. Should be available for everybody to answer right now. So Jason Freeman, I'll turn it back to you. I'm going to close this poll down in a little less than a minute.
Okay, appreciate it. So we've just covered, some of the natural consequences for the way that the IRS treats cryptocurrency. For those who zoned out, again, it's treated as property. We've got a barter transaction effectively on every transaction. We need to know our adjusted basis in the coins or currency that is bought or sold, and we need to know the fair market value of what's received in exchange for those in order to calculate this. But every transaction gives rise to a potentially taxable event, and then the character of the gain or loss, ordinary or capital, ultimately depends upon the manner in which the currency is held by the taxpayer. So moving on to the next question in our deck, how is the fair market value of virtual currency determined? This is one that I perceive to be down the road a pretty serious issue. The IRS, kind of in its initial guidance, took the position that taxpayers could rely upon data published by exchanges, so long as those exchanges were based upon principles of supply and demand. And it raises all sorts of questions about what the heck that truly means. The biggest takeaway in this area I can give, kind of practical advice for accountants, is ensure that you are documenting, can't stress it enough, documenting the basis for the fair market value determination, and keep those files on hand, because if you don't have them and the IRS subsequently initiates an audit or challenges a position, just the way the law works generally, the IRS is going to, if the IRS makes a proposed assessment based on that, the IRS is going to be entitled to a presumption of correctness, and it will be the taxpayer's burden to demonstrate otherwise. And for the most part, taxpayers are going to be unable to do that without documentation to demonstrate how they've come to their conclusions and what they base them on. Accounting for virtual currency holdings, there are all sorts of rules or structures within the Internal Revenue Code, depending on the context, like FIFO, first in, first out, LIFO, last in, first out, specific identification, which in that context, this context probably means identifying the private key or the of the cryptocurrency that's sold, or being able to document the batch that's sold, where they're held through an exchange that doesn't provide you with the private key that's linked to them. This had been kind of an open question for quite a while, and I'll tell you, there are regulations under Section 1012 of the Internal Revenue Code that adopt some of these methods in the context of securities. But again, we don't have anything to go on to say that cryptocurrency is a security for federal tax purposes. All we're told from the IRS is these are it is property generally, and so technically the FIFO method and some of the methodologies thereunder are really just provided by regulation to securities. And so, the legal analysis would be that specific identification would by default be required. Now, that said, the IRS issued some FAQs last year, towards the end of last year, that indicate that it is accepting a FIFO methodology for taxpayers accounting for cryptocurrency. That is kind of welcome news. I will point out, the GAO issued a report that was somewhat critical of the IRS's use of FAQs, and really points out that technically a taxpayer cannot actually rely upon FAQs, as they haven't gone through the APA process, and there are some shortcomings to FAQs as a form of regulatory guidance. Not to mention that the case law is quite clear; you can't rely on them, and there are historically quite a number of incidents where the IRS has taken positions later that were contrary to informal guidance of this nature. But do know that there were FAQs, and that they've provided that taxpayers can utilize under those the FIFO methodology. Although again, in my opinion, specific identification may technically be required under the regulations. Over the years, probably the most common, I guess I would even say today, these days, the most common question I tend to get is whether Section 1031 applies. And it's a good question because, and it's a natural question because, as we mentioned, every transaction is effectively a barter transaction, and so every transaction potentially gives rise to a taxable event unless there is some rule or law that postpones that taxable event. And Section 1031 is one of those types of provisions that generally allows for an avenue to postpone gain where there's something called a like-kind exchange. Now, for years 2018 forward, there's a very easy, straightforward answer to this question, and the answer is no. Section 1031 does not apply. That is a result of the Tax Cuts and Jobs Act of 2017, which specifically removed 1031 treatment with respect to the sales of intangible assets. And so that kind of knocked cryptocurrency out of that realm. But it's still a very relevant question for 2017 and prior. And I can tell you it will remain a relevant question because, again, it's anecdotal, but what we've seen is there are a lot of taxpayers with a lot of cryptocurrency activity that still haven't filed tax returns incorporating this from prior years. And so where that's the case, the IRS is going to have, if no returns have been filed, the IRS is going to have forever to amend it because no statute of limitations will begin to run, and where those where what's been left
Jason,
off.
can you hear me?
I can. Can you hear me?
Yes, I can. We're having some audio kind of cutting in and out. To everyone in the questions panel, we know this is good. This is exactly what I had prepped for in the introduction. This is a side issue. We can't get it off the. It may just take a second to reset. So, Jason, can you still hear me?
I can. I'll wait just a second while y'all work on it.
Do me a favor on the webinar. If you can see me on the GoToWebinar panel, audio settings, switch from computer phone audio to computer. Should be able to all hear again. Can go ahead and switch back. We should have that up. Get back in. All right, poll question number 4 is now live right now. So we're going to leave this open for a little bit while you all get your results.
Jason, are we working? Jason Bookman, can you hear me?
You dial back in. We apologize for the.
It's all right. Well,
Jason, can you hear me?
I can. Can you hear me? Folks, we're almost fixed.
$130. All right. Somebody to be nimble here, and I called in. Hopefully, can you hear me? I hopefully it created a.
Can you hear me?
I can hear just fine.
All right. For everyone who can hear me, again, this is a server-side issue with GoToWeb. We're doing everything to get everything. This is not a local person. This country is working for the same server. Doing the best we can. We do appreciate
the server issue.
Testing 1, 2, making sure that audio is on. Can you hear me? Are you there?
Jason, it's almost to the end. I think what my fourth and final the topic, but a stopping point for us on this. And again, we appreciate everyone's patience. This is it's a server issue with GoToWebinar, and I know they're working on it, but all I can do is point you the material and do the best we can under the circumstances. So we talked,
Jason, can you hear me now?
About 10:30. I can. Me?
The delay on, so we do have a few minutes left. And, yes. There's going to be a delay on this message. Please proceed on. We're going to wrap up at the hour, but we are get through most of the, so we are grateful.
Absolutely. Jason, let's go ahead and I'll go ahead and we'll have section 10 is whether it's for 27 is, is
Jason, can you hear?
The guidance on the IRS on, but it has issued a number of rulings in some relatively analogous contexts. And so I'm going to point to a few of those rulings so that you can you have a feel for the landscape of what is out there. First ruling was dealt with gold bullion held for investment and silver bullion that was held for investment. There was an exchange of those two types of assets, and the IRS held that was not a like-kind exchange under those circumstances. And its analysis really delved into the function and use of the coins in that context, and it found that there was sufficiently different use and utility for gold bullion and silver bullion that led to the conclusion that they were not like-kind property. Now, a second ruling, which comes to a similar conclusion, but is also it's helpful analysis in understanding how the IRS at least looks at this, deals with gold coins. These were numismatic coins rather than investment coins, and so this is one where numismatic implies that the value is determined by age and the number of coins minted, etc.
Hey, Jason, can you hear me?
I can, Jason.
Okay. It looks like everything's been restored. We've been able to hear you for the last few minutes. I just wanted to check that everything was working. Just want to make a quick message to our audience. So, Jason, we can go ahead and keep going for a couple more minutes and get the last bits of the content in that we can. To everyone who's still with us, thank you for your patience and your understanding. The thing that has happened is, as I said earlier, this is a server-side issue. GoToWebinar is a cloud service. What happens when a cloud service that's used to having 10 million people log on suddenly has 100 million people log on is things get a little dicey, and that's what happens. So thank you for bearing with my technical explanation of what just happened. And Jason, back to you. We can go for another 5 or 6 minutes or so and get the last bits of the content in. Thanks again for being patient with all of us.
Absolutely. Thanks, Jason. I appreciate it and appreciate all of y'all's efforts. These are unusually difficult times, and while I sense there's some frustration from some of the viewers, some of the questions, I'm just going to have to, you have to be patient, and everybody's doing the best that they can. Jason, it's probably a good time to launch the last poll question.
I had it launched while we were trying to get the audio troubleshooted, just to try to eat
away
the time, and
so
it
we
already
got
closed.
Excellent. So I'll just finish out this last bit here, and then we'll be about there. This second ruling that I was discussing dealt with gold coins that were held, were numismatic coins, and those were exchanged for South African Krugerrand, which were bullion type coins, but both were held for investment. And the IRS determined that these were, again, not like-kind exchanges, right? So this informs the analysis a little bit more. But there's a third ruling. Yeah.
Real quick, I'm sorry to keep interrupting. Before, just want to say to the audience, if anybody has another webinar that they need to make it to at the top of this hour, you are free to log out right now. If you meet the minimum time and poll requirements, you will have earned your credit. If you want to stay for the content, you are clearly more than welcome.
Great. Well, the third and final one dealt with U.S. gold coins that were held for that were bullion, and South African Krugerrand that were also bullion. And the IRS came to the conclusion that this actually was a like-kind exchange. Now, these rulings go back a number of years. They go back to a time before cryptocurrency, but they carry a number of parallels, and the reasoning and analysis behind them is very informative in this context. About the best that someone can do for you, anyone can really do for you, tell you probably have to get to avoid penalty exposure in taking this position. You have probably got to have an opinion actually provided and performed. But the analysis really looks at the underlying function and technological use of the cryptocurrency and how it relates to the other cryptocurrency that is being exchanged. And so it's a very interesting issue and analysis. The last part, I'm going to go ahead and cut back to kind of a final thought on this, or final issue that comes up quite a bit is whether cryptocurrency needs to be reported for purposes of international tax reporting. And this is one where there's not a unanimous and clear set of guidance for all international tax purposes. FinCEN did come out, somewhat recently with some announcements, kind of taking the position that for earlier years there may not have been an FBAR filing obligation. Currently, the landscape is not at all clear that applies for all purposes. Keep in mind, FinCEN really only has jurisdiction over FBAR reporting obligations, not tax form reporting obligations. So it's not entirely clear what these obligations are, but again, having some working understanding of how these are held and how these work, I would make the argument that when we're looking at what it is with cryptocurrency that truly has value, there's an argument to be made that it is the private key itself that has value, that unlocks the asset that is attached or memorialized to the public key. And a private key can be held in a number of different manners. It can be, it's an alphanumeric strand or passcode. It can be written on a piece of paper, stored on a cold hard drive, in your closet, or maintained on an exchange that may be domiciled anywhere in the world. Those strike me as very different scenarios that may give rise to potentially different reporting obligations. And I think there are, pretty cogent arguments to be made to that effect. And so I would point out that it may make sense for you to drill down further where you've got these issues, to drill down further to understand exactly how the coin cryptocurrency is being held, and how that may impact your international reporting obligation. So with that, we've really hit a lot of points on this and been through a lot of material. Again, I want to thank everybody for sticking with us through this. I know it's been we've had a few technical issues, and I suspect this is going to be the case, for the week to come with GoToWebinar, generally just kind of being bombarded as a result of COVID-19, but and the increased usage on the servers. But I want to thank you all for tuning in today, and we will look at providing this this topic on a subsequent date, and allow those who are interested to come back to rehear some of this information and help with the long-term absorption. So with that, I wish everybody stay happy, stay healthy out there, and have a wonderful day.
Jason, thank you so much. And to everybody who's on with us, again, thank you so much for bearing with us through the technical problems. Again, these are server-side issues with GoToWebinar that happen that we are certainly, unfortunately, not immune to from a technical perspective. This is just what happens when a cloud system gets scaled up to a really, really high level with so many people working from home. We are, of course, grateful that everybody is safe and healthy at home as much as they can be. And as Jason said, thank you for sticking with us. We're grateful that we only lost about a minute or two of time. I know that that minute or two can sometimes feel like an eternity, but we're grateful for you all sticking through with us. We're going to process CPE by the end of the day today. That will be available in your CPA Academy accounts by the end of the day today, or likely within the next 24 to 48 hours. Everyone will have an opportunity to access the archived recording of today's session and the handouts if you need to review anything. Thanks again to Jason Freeman. Thank you again, of course, to all of you. We hope to see you all on future webinars and hope you all have a great rest of the day.